The market has always been about getting to the trade faster than the other guy, right? The market has always been about making sure you have more information than the other guy. Now, the problem is that in today's day and age, when we can have computers and fiber optics and now laser looking forward, we can really get to these trades at light speed, pretty much quite literally. So this is very much an organic process. Now, of course, we have all the technology that makes sure this process can go at the speed of milliseconds. And really the question that we should be asking ourselves is, how is this different? How is this different from the market's past? What is it that we need to do that is more creatively adaptive to regulating these new technologies? I think one of the big problems that regulators are facing is that we don't quite have a definition of what high-frequency trading is and what the different strategies are that actually constitute high-frequency trading. And the CFTC, the Commodities and Futures Trading Commission, the SEC, the FBI now, the Justice Department, all the regulators are on board trying to figure that problem out. And I think one thing that they're coming up against is that we really do not have a set mechanism for identifying that this is a high-frequency trader, this is what they do, and this is how we should control them. And one part of this is that some of it is deliberate. As soon as we have a definition, we have a way, a sort of roadmap for people to skirt that definition and do things outside that definition that give them maximum leeway, but that keep them outside of regulation. So we're really coming up against a definition issue, and that's something that is going to be a problem that we really need to think hard about. And I think regulators really need to be ahead of the curve. The problem is that regulation for so long has been very reactive. We've seen that all the way through the financial crisis, when we only sort of came into an understanding what was happening in the mortgage markets and with securitization, with derivatives markets, very much behind the curve once the explosion had already taken place. And I think the goal here is, and what HFT and other technologies are teaching us, is that regulators really need to be proactive, have a dialogue with the industry at a much earlier stage, have a dialogue with each other at a much earlier stage, and also more saliently these days with international regulators as well, who are seeing similar problems develop in their own jurisdictions and trying to create a convergence as well as a sort of more uniformity, a greater uniformity in the approaches to regulating these global technologies. The big issue here is that HFT affects almost all aspects of market trading, and it's not just HFT's algorithmic trading, the use of computerized programs and instructions to be able to perform, execute, and complete trades. And the big issue here is that it affects not just the actual trading process, it affects entire market actors, brokers, exchanges, and more deeply, as my article seeks to argue, it really affects the ways in which we fundamentally regulate our financial markets, from really central pillars like mandatory disclosure to the other side of the process, which is litigation, which is trying to argue when fraud is taking place and how we identify and action fraud in the markets. All of these major aspects are affected by this fundamental shift in trading, which is the reliance on pre-programmed algorithms to execute trades rather than human beings who are computing information and then trading on that basis. So I think if I am sort of looking forward and providing some kind of input in this, it's really to try and take a real big picture view as to what is going on, not just regulating individual market actors, but taking a good look at the central pillars of securities regulation itself to see how this is changing the paradigm shift that is taking place in this bigger game. And I think the most interesting part as a researcher for the stock market is that you really have an incredible amount of innovation, intelligence, and creativity that goes into the process of trying to make money. And certainly some of these innovations can be extremely beneficial. Even when we talk about HFT, I think the problem is that many people see it as a monolithic concept, but there are also many benefits that can come with it. For example, in certain studies, they've argued that HFT has lowered by something like 15% what investors pay to actually execute the trades. The trades can happen quicker, information can potentially get out faster. At the same time, the fact that it's such a broad-based concept means that there are also potential abuses that can happen. And the key sort of goal here is to try and preserve the benefits without throwing the baby out with the bathwater as it is.